Chapter 15, we're going to talk about the money market fund. And I'm sure most of us have heard of money markets. So basically what it is it's a financial market where there's short-term debt instruments that are very liquid. So you could turn them around in a day if you wanted to. And then there's very low risk. So then it gets into some of the different characteristics. So the wholesale market is basically a large volume market. The short-term debt instruments means it can be repaid very quickly. It's going to be normally like large corporations that are included in that. So they're normally the biggest, safest corporations, which means there's going to be a low level of risk associated with those. But then just knowing investing, if you have easily liquid assets that can turn into cash quickly, and they're relatively low risk, you're going to have a relatively low return. So you're not going to make a huge amount of money on them. So then why do we have money markets? So you would make more than you would in like your regular old savings account. The interest rates are going to be a little bit higher than that. And businesses use them or individuals use them. Sometimes the banks, if you want to set up a money market, sometimes they'll require a certain dollar amount. Like I feel like back years ago, it used to be $10,000. I think it's lower than that now. But businesses use them a lot. When I worked at the oil and gas company as the accounting manager, I did the treasury function. And in that treasury function, every day we'd have to go online and kind of monitor where the money was. So we would look at what money came in from our customers. We had controlled disbursement checking accounts, which means we didn't have to take all the money out when those checks were written. As they cleared, that money would get transferred over to like the accounts payable account or the revenue account or the payroll account. So then we could hold on to our money a little bit longer. But anyhow, every day we'd look at that activity, and whatever money was left over, we would just sweep into a money market account. So when we swept that over, we might pull it back the very next day. It would depend on our cash needs, or maybe we'd leave it in there a week. But it would just be matters of a day or two. And at that point in time, interest rates were much higher than they are now. We earned like 5% interest. So if you swept it every day and you had a certain amount in there over the month, it would add up. So that's kind of why people like money markets. So you've got that surplus cash that you just are going to sweep in, sometimes for short periods of time, and then you do earn more interest than leaving it in a like a passbook savings account. And then it talks about your banks can be your middlemen. So then, of course, they're going to get a cut of it too. So if you are like, and for us, we would have done it through the bank at our business. So they would have been getting a cut of that interest that we were earning also. So then who participates in the money market? The government participates in the money market, large corporations, commercial banks, the Federal Reserve, and then just individual investors who would like to get involved in that type of an investment. Then it talks about details of treasury bills, and our next chapter is going to deal with the bond market, so we'll get more in detail into that in the next chapter. But you do want to understand these treasury bills. So the treasury bills are government bonds, and they are normally issued in $1,000 increments, and sometimes then, like it talks about the discount rate. So sometimes they don't pay interest. Well, the government bonds don't pay interest. In the next chapter, we'll talk about corporate bonds too. Corporate bonds can pay interest, but the government bonds are normally sold at a discount. So say you go to the bank and you buy $100 bond. Well, maybe in 10 years when it matures, you'll get the $100, but today you're only going to pay $40 or $60 or whatever the price is. So then you have to hold it for the whole 10 years to get that $100, and you pay a discounted amount. And then it goes through the different mathematical computations on how you will solve for those. And you may have to do it in the homework, but I won't have that on the test to do the calculations. You just want to understand that they are sold at a discount and that you pay less today, but you'll get the full amount when they mature and when they're due. And then they talk about the different types of yields. So the discount rate yield, it's using that $1,000 because, like I said, that's how bonds are issued. The investment return yield is using how much did you pay for it. So you would have paid less than the $1,000. You would have bought it at a discount, and you got to factor that into really what your return is. Especially if you're a large corporation and you've got $1 million tied up in those bonds, then it does kind of add up. Then it talks about our T-bill auctions, so our Treasury bill auctions. So the Fed is, or the Treasury is going to announce what they're going to auction off from a T-bill standpoint, and then people will bid on them. So then they'll rank them in order of bids. But so say they've got $10 million. No one can say, I'm going to take all 10 million. So the most that a person can purchase is 35%. So you got to figure there's going to be multiple bidders to get to that whole $10 million, since only one corporation or one person could go the 35%. So then they'll rank those bids, and then the lowest bid is what everybody will get. So that lowest bid, the lowest price of the accepted bid, is going to be what all of the people pay, or corporations pay, or whatever. Okay, then the book talks about federal funds, and federal funds are short-term. They're short-term market, so the banks are lending to each other. So what's happening in those federal funds is to say one bank has excess reserves and another bank has lower reserves. So the one that has the excess reserves can loan to the other one who is low on reserves. And a lot of times it's just overnight, because again, with banks, you figure everything changes like the very next day. So it could just be one day, could be a couple days. But then obviously they're not going to do that for free. So there's going to be a rate that's charged. So the banks with the excess funding will give the money to the one that needs the funding, and then charge them interest. Then it gets into that the Fed, after our recession in 2008, the Fed instituted this paying interest on the reserves. So there's a floor, there's a price floor that they pay interest on, and they created that so that the interest rates would not fall really low during times of deflation, when the interest rates are going down. So obviously something in that financial crisis of 2008 led them to believe that they had to institute that. Okay, then there's also commercial paper. We talked about commercial paper, I think, in one of the other chapters, as a way that the bank can make some extra funding. So what that is so say you're a seasonal business, like the textbook gives a good example of Harley Davidson. So obviously during the winter months, at least in half of the United States, you're not selling a ton of motorcycles. So January, February, and March, Harley Davidson might not hardly have any money, but they still want to run their shops and their everything that they've in their factories and all that stuff. So they may need to borrow money. So they'll borrow money with these commercial papers, which again would be short term. So maybe they'll go for 3 months or 6 months. They'll borrow the money so they can make payroll, they can keep up their operations. Then when the warm weather comes in and they start selling a bunch of motorcycles, then they can pay those commercial papers off. So again, it's a way for businesses to borrow on a short-term basis to kind of fund their seasonal needs. A repurchase agreement, or a repo, is when one party sells the treasury bill and agrees to buy it back. So because those treasury bills, like I said, they could maybe go 10 years, they can go a longer period of time. So that the person just says, okay, well, I need a little money now, so I'm going to sell it, and then I agree to buy it back in 30 days or 60 days or however long they need it. Maybe it actually just says sometimes it's just overnight, so it could be very short term. Then there's the jumbo CDs. So then these are going to be comparable to like what we know as a CD. So the CDs are more where you can't add money into it. You'll set it up for however much you need. And then, so say like it was us, we'd put $1,000 in there and it's tied up for 6 months and you get a higher rate of interest. This is more just a bigger case of that. So I think that you have to at least have $100,000. So obviously these are big corporations. And again, you can't add to it. and then you've got a maturity date that you can pull it out plus your interest. So it's just kind of a way for the bigger savers to save. Then there's bankers' acceptances, and then I think this too we had in that same chapter, where again we're another way for banks to make money, so that they can facilitate payment between two parties. So like they mentioned that it's a lot of times, it's a way for a company to do business with another company, maybe in another country. So they want to be sure their money is safe and they're setting up credit. So when they send supplies over, that they know they're going to get paid. So the bank would offer this letter, this banker's acceptance, kind of guaranteeing that that payment will be made to the person. So it's a promise to pay them in the future. Then there's the Eurodollar accounts. So that doesn't have to just be in euros, but it's a bank account that's denominated in another currency of another country. And it's a way for the U.S. banks to transfer some money into those other funds that they need to have, like whether it's euros or another currency. So we can see there's the money market is a very viable financial market, and it is very important for both businesses and governments and even for investors.